WorldCom filed for bankruptcy in July 2002. At the time, it was the largest corporate bankruptcy in American history. The company had reported billions in profits. Those profits did not exist. WorldCom did not collapse because demand for telecommunications vanished. It collapsed because expenses were treated as assets. The company grew through aggressive acquisitions. Debt financed expansion. Revenue growth slowed. Pressure to meet earnings targets intensified. Instead of reporting higher expenses, billions were capitalized. Routine operating costs were recorded as long-term investments. Profits appeared stable. Cash flow did not. The failure was not technological. It was accounting structure masking financial deterioration.
In the 1990s, telecommunications was treated as national infrastructure and financial opportunity. Long-distance voice traffic was expanding across the United States. Internet usage began accelerating at commercial scale. Fiber optic cable networks were laid across states and continents. Bandwidth became a strategic asset. Telecom carriers competed to control transmission capacity. WorldCom, founded in 1983, entered this environment as an aggressive consolidator. It did not build dominance organically, it purchased it. Throughout the 1990s, WorldCom acquired regional telecom operators. Each acquisition expanded its network footprint. Each deal increased reported revenue. Scale became central to its valuation thesis. Investors viewed telecom as the backbone of the digital economy. Analysts projected sustained traffic growth. Market optimism supported rising equity valuations. WorldCom used its stock as acquisition currency. Share price appreciation enabled larger transactions. In 1998, WorldCom acquired MCI in one of the largest telecom mergers of the era. The transaction reshaped industry structure. Network assets expanded rapidly. Operational integration complexity increased. Revenue figures continued to rise. The company presented itself as a global communications platform. Capital markets rewarded consolidation. Debt markets remained accessible. Expansion appeared aligned with industry momentum. Telecom demand forecasts supported infrastructure build-out. Competitors pursued similar strategies. Industry scale was interpreted as resilience. WorldCom's market capitalization grew accordingly. The company became a symbol of telecom-era ambition. Boardroom presentations emphasized capacity growth. Financial models assumed continued traffic expansion. Earnings expectations incorporated acquisition synergies. Reported performance appeared consistent with strategy. However, integration costs accumulated beneath headline revenue growth. Network maintenance expenses were substantial. Line costs paid to other carriers were recurring. These costs scaled with traffic volume. Acquisition financing increased leverage. Balance sheet complexity intensified. Growth masked structural obligations. The market focused on scale. Less attention was paid to cost architecture. WorldCom's expansion strategy tied valuation to continued growth. Structural takeaway: rapid acquisition-driven expansion can amplify scale while embedding cost structures that become visible only when growth slows. WorldCom's expansion was not incremental. It was acquisition-driven at scale. Throughout the 1990s, management pursued increasingly larger targets. Each acquisition expanded geographic reach. Each acquisition increased reported revenue immediately. Integration was presented as strategic synergy. Operational overlap was framed as efficiency opportunity. The market rewarded transaction size. Bigger deals signaled ambition. Share price appreciation became strategic leverage. WorldCom used equity to finance purchases. Rising stock valuations lowered perceived acquisition cost. In 1997, WorldCom acquired MFS Communications. In 1998, it acquired MCI in a landmark transaction. The deal positioned WorldCom as a global telecom operator. Revenue surged following consolidation. Balance sheet assets expanded rapidly. Goodwill accumulated as purchase prices exceeded tangible value. Debt issuance supported transaction financing. Credit markets extended substantial capital. Interest obligations increased. However, acquisition announcements temporarily boosted equity value. Reported earnings included post-merger synergies. Expense incurrencies were substantial but treated as transitional. Market analysts emphasized combined market share. Operational scale was equated with competitive advantage. Telecom infrastructure assets expanded across continents. Fiber networks increased in capacity. Traffic routing became more complex. Back-office integration required system alignment. Accounting systems consolidated multiple legacy entities. Revenue recognition practices were harmonized. Expense classification required coordination across subsidiaries. As integration proceeded, revenue growth began moderating. Competition intensified within long-distance services. Pricing pressure emerged across wholesale bandwidth markets. Industry overcapacity began forming. Network build-out across competitors exceeded demand growth. Revenue projections embedded optimistic traffic assumptions. Acquisition-driven growth required continued expansion to sustain momentum. Debt servicing required stable earnings. Market expectations remained elevated. Quarterly performance became central to valuation. The acquisition engine could not pause without signaling weakness. Operational complexity increased internal reporting challenges. Financial reporting depended on consolidated system accuracy. As revenue growth decelerated, acquisition-based expansion lost velocity. The structure required consistent earnings delivery to maintain confidence. Structural takeaway. Acquisition-fueled growth can expand revenue rapidly, but it embeds leverage and integration complexity that increase vulnerability when growth moderates.
As acquisitions accumulated, leverage became structural. Debt financed expansion across the telecom network. Bond issuances supported large-scale transactions. Credit ratings remained investment grade during peak expansion. Interest expense increased alongside principal obligations. Balance sheet leverage ratios climbed steadily. Debt was justified by projected traffic growth. Financial models assumed continued revenue acceleration. However, telecom pricing began compressing. Wholesale bandwidth rates declined. Competition intensified among carriers with excess capacity. Revenue growth decelerated across the sector. Debt service obligations did not decline. Interest payments remained fixed. Covenant compliance required stable earnings. Cash flow became central to sustainability. Operating expenses scaled with network usage. Line costs paid to other carriers remained recurring. Capital expenditures remained high due to infrastructure maintenance. Integration costs from acquisitions persisted. Synergy realization did not fully offset expenses, yet reported earnings remained comparatively stable. Leverage amplified sensitivity to revenue shifts. Small declines in revenue affected coverage ratios materially. Debt markets began reassessing telecom exposure. Investor sentiment shifted cautiously. Equity valuations became more volatile. The telecom bubble began deflating. Capital availability tightened. Refinancing risk increased. Internal financial reporting faced growing pressure. Quarterly earnings targets remained unchanged. Analyst expectations reflected prior growth assumptions. Management guidance attempted to maintain stability. Debt obligations limited operational flexibility. Liquidity planning became increasingly important.
Cash flow variability exposed structural strain. However, headline earnings did not immediately reflect deterioration. Interest coverage appeared adequate. Reported margins did not collapse. External observers saw a leveraged but functioning enterprise. Internally, leverage narrowed margin for error. Cost discipline became critical. Accounting classification decisions gained importance. Revenue softness increased scrutiny on expense lines. Debt created structural urgency to maintain earnings optics. The system required stability to sustain leverage. Structural takeaway. High leverage increases dependence on consistent earnings, magnifying the impact of revenue slowdown on financial stability.
By the early 2000s, telecom growth forecasts began diverging from reality. Industry capacity had expanded faster than demand. Fiber networks were underutilized. Wholesale bandwidth pricing declined across markets. Long-distance traffic growth slowed materially. Revenue expansion no longer matched prior projections. Acquisition momentum had masked emerging softness. Now the underlying demand environment was visible. WorldCom's reported revenue growth decelerated. Quarterly comparisons became more difficult. Analyst models still embedded prior assumptions. Debt obligations remained unchanged. Interest payments required predictable cash generation. Operating expenses continued to scale with network usage. Line costs represented a significant recurring expense. These costs were directly tied to traffic volumes. As revenue slowed, margin compression risk increased. Earnings targets remained aligned with prior growth expectations. Capital markets monitored quarterly performance closely. Telecom peers began reporting revenue pressure. Industry consolidation slowed. New acquisition opportunities diminished. Organic growth became necessary. Organic growth proved slower than acquisition-driven expansion. Internal financial planning faced tension. Cash flow projections tightened. Management confronted earnings volatility. The market environment no longer absorbed performance variability. Valuation stability depended on consistent profitability. Small expense increases materially affected reported income. Revenue recognition did not offer structural flexibility. Expense classification became increasingly consequential. The accounting treatment of costs influenced reported margins. Recurring operating expenses reduced net income. Capital markets interpreted declining earnings as structural weakness. Debt covenants increased sensitivity to income statements. Pressure intensified around quarterly reporting cycles. Internal discussions focused on meeting earnings guidance. Cash flow lagged behind reported profit stability. External stakeholders saw moderated but positive performance. Internally, the gap between cash flow and reported profit widened. The accounting system became the interface between operational stress and market perception. Financial presentation choices gained strategic weight. The slowdown did not create collapse, it created pressure. Structural takeaway. When revenue growth slows within a leveraged structure, accounting treatment of expenses becomes central to maintaining reported stability. As revenue growth slowed, earnings targets did not adjust proportionally. Analyst expectations remained anchored to prior expansion rates. Quarterly guidance became a central management objective. Debt obligations required stable reported income. Credit ratings depended on perceived earnings strength. Internal forecasting began showing margin compression. Operating expenses consumed a larger share of revenue. Line costs represented a significant recurring charge. These costs were necessary to transmit traffic across networks. They were not discretionary. Reducing them risked service degradation, yet reporting them fully would reduce earnings materially. Quarterly comparisons intensified scrutiny. Equity markets reacted quickly to earnings misses. Management credibility became linked to consistency. A gap emerged between operational reality and market expectation. Cash flow variability increased. Reported net income remained comparatively steady. The difference required explanation within internal accounting systems. Expense lines offered structural flexibility. Classification decisions influenced profit presentation.
Routine network access charges were recorded as operating expenses. These charges were substantial and recurring. Reclassifying them altered income statement timing. Capital expenditures were amortized over multiple years. Operating expenses reduced profit immediately. The distinction determined reported earnings trajectory. Pressure to maintain stability concentrated within accounting processes. Internal controls relied on managerial judgment. Documentation supported expense categorization decisions. As reporting cycles continued, capitalization activity increased. Operating cost recognition declined. Profit margins appeared preserved. Cash flow patterns did not align proportionally. External observers saw steady performance. Internal financial staff recognized emerging inconsistencies. The accounting system became a mechanism for earnings smoothing. No immediate external contradiction appeared. Debt service obligations continued. Market perception remained temporarily intact. The structure functioned while revenue pressure persisted. However, reliance on classification adjustments increased. The sustainability of this approach depended on continued concealment within reporting categories. Structural takeaway. When earnings pressure intensifies, accounting classification becomes a lever that can temporarily preserve reported stability while underlying cash stress accumulates.
The central accounting adjustment involved line costs. Line costs were payments to other carriers for network access. They were recurring operating expenses. Under standard accounting treatment, they reduced income immediately. WorldCom began capitalizing a portion of these costs. Capitalization recorded expenses as long-term assets. Instead of appearing on the income statement, they were moved to the balance sheet. Assets are amortized gradually over time. This delayed expense recognition. Reported earnings increased as immediate cost burden declined. Cash flow did not change. The economic outflow still occurred. However, income statement presentation improved. The adjustment was not marginal. Billions of dollars were reclassified. Approximately $3.8 billion was initially disclosed. Later investigations identified even larger totals. The accounting entries were recorded within internal systems. Capital expenditure accounts expanded proportionally. Quarterly profit targets were met. Debt covenant ratios remained compliant. Analyst models incorporated reported margins. External observers saw stabilized performance. The telecommunications slowdown remained visible in the industry, yet WorldCom's reported earnings appeared resilient. Internal accounting staff recognized the magnitude of reclassification. The distinction between capital investment and operating expense blurred. Documentation supported classification decisions. Managerial authorization approved adjustments. The entries were not isolated. They occurred across reporting periods. Capitalized line costs accumulated on the balance sheet. Asset totals increased without corresponding infrastructure expansion. Depreciation schedules extended cost recognition over years. Immediate expense recognition was avoided. Cash flow statements reflected operational outflows. However, income statement optics improved. The structure delayed recognition of operational stress. Leverage ratios benefited from preserved earnings. Market confidence remained temporarily stable. The accounting shift did not generate new revenue. It redistributed expense timing. This redistribution masked declining margin reality. The longer it continued, the larger the accumulated adjustment became. The adjustment required continued concealment. Once examined directly, the classification could not withstand scrutiny. Structural takeaway. Capitalizing routine operating costs can delay earnings deterioration, but it converts immediate stress into deferred structural exposure. The capitalization practice continued across reporting cycles.
Asset balances associated with line costs accumulated. Depreciation schedules extended recognition into future periods. The gap between reported profit and cash flow widened. Internal audit functions reviewed accounting entries periodically. Routine review procedures examined capital expenditure classifications. Unusual growth in capitalized line costs drew attention. Internal auditors began requesting supporting documentation. Accounting staff provided schedules and justifications. The explanations relied on managerial authorization. However, documentation did not align with operational reality. Line costs lacked characteristics of long-term assets. They did not create enduring infrastructure value. They represented recurring network access payments. The internal audit team escalated concerns. Senior financial executives were questioned. Reclassification volumes were compared across quarters. Patterns indicated systematic capitalization. The amounts were material relative to total earnings. Internal reporting highlighted discrepancy between cash outflow and reported income. The issue was no longer theoretical, it was numerical and traceable. Audit findings were communicated to senior management. The audit committee was informed. External auditors were notified. Further review identified additional improper entries. The initial estimate of $3.8 billion reflected only part of the total. The magnitude exceeded prior expectations. Earnings for multiple prior periods were overstated. The accounting structure could not sustain reclassification under investigation. Once questioned, supporting documentation proved insufficient. Capitalized balances required reassessment. Income statements required restatement. The discovery shifted the issue from pressure to exposure. The company announced an internal investigation. Disclosure preparation began. Credit rating agencies were alerted. Liquidity concerns intensified. Investor confidence weakened rapidly. The accounting mechanism that preserved stability now triggered instability. Capitalized assets lost legitimacy. Debt covenant compliance was threatened. The reclassification strategy collapsed under audit scrutiny. The structural weakness had been embedded within reporting systems. Internal verification exposed what external reporting had not. Structural takeaway. When internal audit challenges expense capitalization, delayed recognition converts accounting flexibility into immediate structural crisis.
In June 2002, WorldCom publicly disclosed accounting irregularities. The initial disclosure referenced approximately $3.8 billion in improperly capitalized expenses. The announcement immediately altered market perception. Previously reported profits required restatement. Earnings for prior quarters were revised downward. The income statement no longer supported prior valuation levels. Equity markets reacted rapidly. Share price declined sharply following disclosure. Credit rating agencies downgraded the company. Debt refinancing became uncertain. Counterparties reassessed exposure limits. Liquidity planning shifted from growth to preservation. Management credibility deteriorated. Investor trust weakened. The magnitude of misclassification expanded under further review. Additional billions were identified. The accounting shift had affected multiple reporting periods. Capitalized balances required reclassification as expenses. Reported equity contracted. Leverage ratios worsened. Debt covenants approached breach thresholds. The market now understood that prior profitability was overstated. Cash flow had never matched reported earnings. The discrepancy was now formalized. Analyst models were recalibrated. Projected earnings trajectories were abandoned. The telecommunications industry was already under stress. This disclosure isolated WorldCom further. External auditors withdrew prior assurance. The board replaced senior financial leadership. Regulatory authorities initiated formal investigations. The scale of misstatement surpassed recent corporate failures. At the time, it exceeded the impact of Enron. Capital markets interpreted the disclosure as structural accounting failure. Institutional investors exited positions. Bond spreads widened materially. Operational stability became uncertain.
Vendor relationships were reevaluated. Employee morale declined. The reclassification exposed years of deferred expense recognition. The accounting mechanism that delayed stress now accelerated collapse. Public confidence eroded in days. The disclosure did not create weakness, it revealed it. Structural takeaway. Public disclosure of deferred expense recognition transforms hidden accounting strain into immediate market instability. Following disclosure, liquidity pressure intensified rapidly. Access to capital markets narrowed. Credit counterparties reassessed exposure limits. Bondholders evaluated recovery prospects. Refinancing options diminished. Debt obligations remained fixed. Interest payments continued to accrue. Cash reserves were insufficient to offset confidence loss. Equity value contracted sharply. Market capitalization declined within days. Vendor relationships required reassurance. Network operations demanded ongoing settlement payments. Operating continuity depended on creditor cooperation. Debt covenant compliance became unlikely. Rating downgrades increased borrowing costs. Management entered restructuring discussions. Advisors evaluated bankruptcy protection. Asset sales were considered. However, infrastructure value was tied to integrated operations. Breaking apart the network reduced recoverable value. Liquidity forecasting showed constrained runway. Cash flow could not stabilize leverage ratios. Restated earnings removed prior margin support. The accounting adjustment eliminated reported profitability. Creditors prioritized asset preservation. Negotiations with lenders accelerated. Confidence in financial reporting had collapsed. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy. At the time, it was the largest corporate bankruptcy in American history. The filing surpassed the scale of Enron. Equity holders were effectively wiped out. Bondholders faced significant losses. Telecom markets absorbed systemic shock. Industry consolidation accelerated. Regulatory review intensified. Employees faced operational uncertainty. Network operations continued under court supervision. The collapse unfolded within weeks of disclosure. Years of reported profitability reversed quickly. The accounting structure could not withstand liquidity stress. Debt amplified the impact of restated earnings. Once expense recognition normalized, solvency conditions failed. The bankruptcy did not originate from technological obsolescence. It originated from accumulated accounting distortion. Deferred recognition had postponed financial reality. When recognition occurred, the structure could not absorb it. Structural takeaway. When leveraged structures rely on deferred expense recognition, restatement converts accounting adjustment into immediate insolvency.
The bankruptcy of WorldCom reshaped corporate governance in the United States. Regulators examined the role of accounting oversight. Congress accelerated legislative response. In July 2002, the Sarbanes-Oxley Act was enacted. The law strengthened internal control requirements. Executive certification of financial statements became mandatory. Audit committee independence standards were expanded. Internal control testing became a formal reporting requirement. External auditors faced stricter independence rules. Public companies were required to enhance disclosure discipline. Capital markets demanded improved transparency. Accounting standard enforcement intensified. Telecom industry valuations were recalibrated. Debt issuance standards tightened. Boards increased scrutiny over expense classification. Internal audit functions were strengthened across industries. The role of the audit committee gained prominence. Whistleblower protections were formalized. Financial reporting processes became more proceduralized. Expense capitalization policies received closer examination. Analysts incorporated governance risk into valuation models.
The case became a benchmark for earnings manipulation risk. Regulators increased inspection of large issuers. Audit documentation requirements expanded. Management accountability expectations rose. Investor trust required structural reinforcement. The telecommunications sector continued consolidating. Asset write-downs across the industry reflected overcapacity. Capital expenditure discipline improved. Balance sheet transparency became central to investor relations. Market perception shifted from growth optimism to cash discipline. Earnings quality became a valuation factor. Deferred expense recognition practices were scrutinized. Rating agencies incorporated accounting quality metrics. Public company boards prioritized compliance infrastructure. The event influenced corporate reporting standards globally. WorldCom's restructuring eventually led to reorganization. The company emerged as MCI before later acquisition. However, the collapse remained a reference point. It demonstrated the limits of accounting flexibility. It reinforced that expense timing does not alter economic reality. Capital markets adjusted oversight expectations. Corporate executives recalibrated reporting risk. Structural takeaway. Structural accounting distortions can prompt regulatory reform, but reform follows failure rather than preventing it in advance.
WorldCom's collapse was not caused by disappearing demand. Telecommunications usage continued to grow. Network infrastructure remained operational. The failure originated within financial reporting structure. Acquisition-driven growth created scale. Debt amplified dependency on stable earnings. Revenue slowdown introduced margin pressure. Expense recognition became strategically sensitive. Line costs were reclassified as capital assets. Immediate income statement pressure was reduced. Deferred recognition accumulated on the balance sheet. Reported profits appeared resilient. Cash flow signaled underlying strain. Leverage magnified exposure to earnings volatility. Debt covenants relied on reported profitability. Investor confidence depended on income stability. The accounting shift delayed recognition of stress. It did not remove it. Capitalized balances expanded without creating new infrastructure. Depreciation schedules postponed expense realization. Internal audit eventually challenged classification logic. Disclosure revealed accumulated distortion. Restatement eliminated prior reported earnings. Leverage ratios deteriorated rapidly. Liquidity access contracted. Bankruptcy followed within weeks. The collapse sequence appeared sudden. However, structural weakness had been present for years. Accounting structure functioned as a timing mechanism. Timing adjustments can smooth earnings temporarily. They cannot change cash economics. Operating expenses remain economic outflows. Debt remains contractual obligation. Market valuation rests on reported credibility. Once credibility declines, leverage accelerates consequence. Deferred stress concentrates future exposure. When recognition occurs, adjustment magnitude is larger. The telecommunications industry survived. The accounting structure did not. Corporate governance frameworks strengthened afterward. However, reform followed exposure. The case illustrates structural dependency on expense timing. Accounting classification influences presentation. It cannot alter economic substance. Delayed recognition increases eventual correction magnitude. Accounting structure can delay recognition of stress, but it cannot eliminate it. Corporate collapse is structure meeting stress. Structural takeaway. Sustainable financial stability requires accurate expense recognition aligned with economic reality, especially within leveraged expansion structures.